Coronation's Balanced Defensive Fund ended the first quarter of 2012 with 9.6 billion rand under management, placing it among the largest funds in the local unit trust industry. The fund returned 10.2% per annum over a 5-year period and also won the Morningstar Award in February for Best Fund under the South African Rand Cautious Allocation category. For more, I'm joined by Charles de Kock, Portfolio Manager at Coronation. I see, Charles, your premises about capital preservation in real terms, given what's happened on the markets today. I'm sure that there are going to be a number of investors heading for the hills, which may very well be your balanced fund.
There's no doubt there's a lot of volatility and a lot of negative news out there, but a fund like the one that I manage, the Balanced Defensive, is ideal for nervous investors because it is a very conservative product.
Just in terms of your allocation at the moment, I see domestic assets sitting at some 75 or 76% compared to your international asset allocation of just over 24%. You're obviously a lot more bullish on the local scenario. Is that a fair assumption, or is this just about what you can allocate offshore?
Yeah, no, your last statement is more true. It's we're allowed only a maximum of 25 offshore, and I'm almost at that maximum. The fund grows so quickly that it's very difficult to stay at the 25 because we get lots of inflows coming in daily. But no, I do think that the South African equity market looks more expensive than the global stocks. And if you dig down into the portfolio, you'll see I have about 10% in domestic equity and almost double that, sort of 18% in global equity, which is a reflection of the fact that we think there's better value in the offshore market than domestic.
Charles, I mean, that's very interesting, and just maybe unpacking that a little bit. If you're looking at that in your international allocation, it's really skewed very much towards the equities, and you've steered away from your bonds in the global space. Yet globally, we've almost seen over the recent while investors preferring the bond market as almost your safe haven type of play. On that equity allocation, A, maybe just some indication in terms of why you've selected that, and then B, in terms of regional or sectoral allocation, what does that actually look like under the covers?
Good question. Yes, the fact that near-term investors have poured their money into the bond market isn't something that we at Coronation want to follow at all. We think that's a very short-term approach. That's a safety-first approach. And if you look at the yields on global bonds, I think the German 10-year bond is trading at something like 1.3%, might even be lower today, and the US one at 1.7%. And the ones that are trading at very high yields, the Greek or the Spanish or so on bonds, those aren't the ones you want to own either. So we actually find very little or zero value in global bonds. So we do find, conversely, good value in equities.
Yes, and let's pick up and just to point out
global equities.
Just to point out, so while we're on the bond theme, that you're obviously finding good value in local bonds because your exposure on that front is around about 46% when it looks at your domestic allocation.
Yes, again, you must look at the detail there that we are not exposed much to the conventional government bonds. What we do own, we own a lot of inflation-linked bonds, and we do own a lot of corporate bonds where the spreads over government bonds is attractive to us. But in the normal sort of ordinary conventional government bond, we own nothing there in SA bonds and nothing in global government bonds as well.
Now, Charles, I think just going back to that equity component, I mean, you're not terribly concerned in terms of the downside risk, in terms of if you look at the relative value globally between the bonds and the equities, and again, just maybe unpacking that in terms of geographical and sectoral exposure.
Yes, if you asked about the downside exposure, a crisis like we are going through currently in Euroland, yes, the stocks can fall quite a bit more, I'm sure, but you have no idea of when the bottom is reached. But when something offers good value, our approach is to accumulate it. And if it falls more, we'll accumulate some more. But in total, with about 10% in domestic stocks and 18% in global stocks, it's only 28% of the portfolio exposed to the risky part of the market. That is still a very conservative approach, with the bulk in cash and income-bearing assets. So it is a conservative product, and it's designed to be conservative by its asset allocation nature, and therefore the shakeout in the risk assets happening at the moment affects a fairly small part of the portfolio. So you know, this fund has never gone negative over any 12-month period, and we don't think it will. It's supposed to withstand that.
Okay, and I mean, just
regards
one
the
yeah.
sectoral or country exposures of offshore, we are lighter in Europe and heavier in the US. We also have a reasonable emerging market exposure where we find pretty good companies on undemanding ratings, and but spread across many of the emerging countries, including China, including Brazil, including Mexico, and a few others.
Okay, I mean, and just one last question with regards to that bond allocation, which is the chunkier part in terms of your asset allocation locally. Your views on the local yield curve. I mean, we're seeing that short end of the curve really being bid very, very strongly, and I mean, fairly strong interest there from foreigners. What's your outlook in terms of how that plays out? Do you see that curve steepening or in fact flattening out, and from which end would you see that?
I would think that the Reserve Bank will basically sit on their hands for quite some time. I know we're just outside the inflation, the upper end of the target at 6.1%, but in the light of the US and Europe and Japan, those big Western countries having a zero interest rate policy, and in the light of a fairly sluggish, call it you know, below par economic growth in South Africa as well, I think the Reserve Bank is going to do nothing for quite some time. Now, does the yield curve steepen or flatten from here on? I really don't know, but I think the next move in interest rates at the short end will be up. It's just not soon. And I think at the long end, if you take a cue from the US and the German bunds, I think the next big move is bound to be much, much higher rather than lower, and that will affect our yields on our long bonds as well. So for that reason, more than any other, taking the cue from where the global bonds are, I shy of our longer dated stocks.
Charles, let's just drill down into the equity side of things, and you did state that you obviously see more value in offshore equities when comparing that to the local equity spectrum. Drilling down into your top 10, I see some exposure to a couple of South African stocks, namely, perhaps to just kick off with MTN. And obviously MTN has been rocked by the recent furore around Iran. You still backing this story? You believe MTN's got significant legs going forward?
Absolutely. I think it's a fantastic company. And yes, the story around the Iran license is a worry, but the share price immediately reacted downwards by about 7 or 8%, which is more or less the value of that Iran part of the total makeup of its profits. So I think it's already priced as though the Iran portion is worth nothing. And I think you know, the cell phone industry is still a remarkable one. Looking forward, I think people will use cell phones forever and a day. And the dominant player in Nigeria, they're the second biggest player in South Africa, and in various other African markets they're exposed to as well, and still growing strongly. So I think the future profits will still come. And the big capital expenditure that they've put in the ground is basically done. There'll be ongoing capital expenditure, there's no doubt about that, but less than in the past, and it's a big cash generating business. So I think one will get handsome dividends coming from MTN in the future.
Charles, I think one last thing from me in terms of the stocks specifically, I see quite a decent allocation there, relatively in terms of the equities that you hold to Sasol. Your views on the oil price, that stock certainly suffered in recent times because of what we've seen globally, but maybe just give us a bit of flavor in terms of what you see playing out in the global oil market and Sasol specifically in terms of a value play. And
Charles, just before you answer, I'm going to add, because I'm going to pitch you against Paul Swanson, who's joining me from Stan Lib in just a moment to talk to us about his balanced portfolio. And they hold no Sasol. They sold out of the stock. They're concerned about the quality of earnings going forward, and also very concerned about the fact that no new projects are coming online. So perhaps I can just add that before you answer.
Okay, well, it's always, market is made by different people taking different views. Sasol, in our view, among the commodity stocks, is one of the better ones. It's inexpensive in our view. As to the oil price, we don't price Sasol as though the oil price is going to remain at $110 or $120 a barrel. We think a fair value, a fair oil price over a long-term normal oil price is more like $80 a barrel. And we think the Sasol share price actually reflects even a lower price than that. So it's not as though the current share price has discounted a oil price maintaining above $100 a barrel going into the future. And as regards future projects are concerned, I beg to differ. I think they have an enormous amount of projects that they could potentially bring on. The biggest being in the US with the shale gas projects there. Now that hasn't started yet, and they're still doing due diligences there, but that is a project that could be company changing in terms of its size.